Hello everyone. Let's begin by looking at the key global developments driving the rates market. In its June policy meeting, the US Federal Reserve held the Fed funds rate steady at 4.25% to 4.5%, broadly in line with market expectations. While the pause was expected, the Fed's updated projections indicates cautious story. Growth is now forecasted to slow to 1.4% in 2025, down from 1.7% in March projections. The unemployment rate too is expected to edge higher at 4.5% next year compared to 4.4% earlier. Inflation, however, remains the stickiest part of this puzzle. Core PCE, the Fed's preferred inflation measure, is now projected at 3.1% in 2025, up from 2.8%. Further, inflation is no longer expected to return to the Fed's 2% target even by 2027. And finally, the dot plot continues to signal 2 rate cuts in 2025. But it's a close call, as 8 FOMC members expect 2 cuts, while 7 see no cut at all. In contrast, the Fed chair appeared inclined to wait for clearer signals on inflation and impact of the recent tariff developments. Fed chair's recent testimony also hints that September could be potential window for the rate cuts if incoming data supports it. Overall, Fed's tone and the trajectory of incoming data suggests that unless the labor market weakens significantly, September remains the earliest likely point for policy easing. In Indian markets, yield curve has seen significant adjustment post MPC announcements last month. Now, after the front-loaded policy action by MPC, the key debate is whether the duration remains the right strategy going forward. To answer this, we need to figure out what the market is pricing in. The long end of the yield curve has responded sharply to the RBI's shift in stance to neutral, which has signaled that the bar for additional rate cut is now higher. The announcement of 1% CRR cut starting November has also reduced the need for further OMO purchases, which has previously supported the belly of the curve. So now there are 2 distinct forces moving the yield curve. On the shorter end, yields are getting supported from liquidity infusion by RBI and to an extent still forming expectations of a further policy rate cut. On long end, however, yields are under pressure due to weaker investor demand and absence of support from OMOs. Another subordinate effect of past OMOs is the drop in level in banks' investment position in government securities as they had done last year. All this has meant continued steepening of the yield curve, which has pushed up the longer yields to a reasonably attractive level. Looking ahead, easy liquidity conditions and a falling credit to deposit ratio are expected to support banks' demand for government securities. Short end of the curve should remain supported with low overnight rates and strong system liquidity. For the long end to perform, markets has to start pricing in another rate cut. This looks plausible if inflation continues to surprise on the downside and if growth indicators such as urban consumption, private capex, and external demands remain subdued. Globally, the Fed is also expected to cut policy rates with the market pricing in 2 rate cuts starting September this year. Thank you.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.